Hello students, welcome to this session. In our previous video, we have discussed about the importance of accounting in a business organization, how accounting is considered as a source of record of financial information and who are all the users of that information, and we have also learned some basic differences in accounting such as cost accounting, management accounting and financial accounting. So now we will see what are the characteristics of accounting information. So first one is reliability. Reliability means that the users must be able to depend on the information, or in other words, the users should be able to trust the information that is provided by the accounting team. So accountancy, as we already know, is the process of recording of financial information and providing that financial information to the users who will use that information for decision making purposes. So the entire decision making process is based on what is being reported as an accounting information. Therefore, that data needs to be 100% truthful, and it also should be reliable, and it also should be measured quantitatively. So a reliable should be information should be free from errors, bias, and it must be neutral and faithful. So it should not be in a way that it favors the business organization, or it favors the management, or it favors the shareholders or anything. There is no favoring. The accounting information should be truthful and only truthful and nothing else. It is just a data based on which the users of the information should be able to come to a conclusion or a decision. So the next one is relevance. Obviously, any data that we want to use have to be relevant to the information that we want to acquire. So to be relevant, the information must be available in time, helping them form prediction about the outcomes of the past, present or future events, and or confirming or correcting the past evaluations. These are the two goals of obtaining relevance in accounting information. In other words, to put it simply, the data that the users of accounting information acquires should fulfill their goal. If the data is acquired by the users to know the past performance of a business, they should be able to acquire that information. Or if they want want the data to decide whether to invest in the business or not, they should be capable of acquiring enough information to make the decision. So that's what relevance is. Next one is understandability. Accounting is kind of a complicated subject, as in the whole language of accounting is not exactly common for all the people. That's why we have experts who draw up conclusions, theories, definitions, and everything to make a standard presentation of the style of information that we are providing. So therefore, in accounts there are a lot of technical areas where we have to use technical terminologies in certain ways, such as balance sheets, trading, profit and loss accounts, and other n number of reports that we create. And most of the reports are only readable by the creators or the people who belong to the accounting department. But the final accounting report or the financial statements should be in a way that it should be readable by any normal human being, any common man. So only that whole point of recording is whole goal of recording is fulfilled. So only when it is useful to the common man who is a stakeholder in the business, the only when it is understandable by a common man, the accounting information is useful for all. So accounting information should be understandable by all. comparability. So not only that the accounting information should be relevant, reliable and understandable, it should also enable the user to compare between other accounting informations of a different company or the same company for the past year or past month or so. So if a company releases a profit and loss statement for the year 2019-20, the reader of the information such as the balance sheet or the profit and loss account should be able to compare that information with the profit and loss account of 1920. So to make that happen, the accounting information should be measured with the same units. So it cannot be like you can measure it in dollars in the past year and then in rupees in present year, or you can use certain accounting principles in the last year and different accounting principles in the next year, which will show a different level of assets and liabilities for your company without changing anything. So without those discrepancies, the two different statements should be comparable with each other, not only from the same company but also from a different company, to know the position of this company with respect to the entire market. So objectives of accounting, some main goals of accounting are being listed here. First one is maintenance of recording of business transactions. Not only we should record the business transactions, we should also the maintenance of record for n number of years as much as it is required. So for government purposes, the Indian government has ordered each company to keep a record of all the business transactions for at least the last 8 years from the current date. So if a government comes to your business and they knock on your doors and ask you for accounting information, you should be able to provide the record of all the financial data for the last 8 years from that date. But the business organizations, for their own good, keep accounting information for very long purpose than that. So therefore all the information such as sales, receipts, purchases, payments, profits, losses, incomes, outgoings, revenues, everything will be recorded and verifiable and kept as an evidence for future verification by the accounts department. So calculation of profit and loss. The owners of the business are keen to have an idea about the net results of their business operations periodically. Obviously, the whole point of doing business is to earn profit. But what's the use of it if you work a whole year and you don't know whether your company has earned profit or not in that year? So to gather a result of that, the accounting department comes up with the profit and loss statement at the end of the year. So that statement basically tells whether the company has earned a profit or not. So profit means excess of revenue over expenses. So revenue means whatever that comes in, whatever the cash that comes in as an income to the business. Expense means whatever the company spends to obtain that cash, obtain that revenue. So if whatever that comes in, or the income or revenue, if that is more than the expenses that is made by the company, it's called a profit. So in the given example, if the total revenue for the given period is 6 lakh and the total expense is 5 lakh 40,000, the profit will be equal to 60,000, which is the difference between 6 lakh and 5 lakh 40,000. So that is the profit. But if however the amount of total expenses made by a business is more than the amount of revenue that is acquired by the business, it means the business has suffered a loss. So in that case, the business should strive to have more revenue, or they should strive to spend less money.